Hi candidate, welcome to another session of manifested earning crisis. So in this session, I want us to look on another illustration from the topic of deferred tax, and specifically the illustration I want us to do is from the sitting of November 2019, specifically question number 5B. So let's go through the question. We see what the examiner was requiring. So the question reads, Mafuta had a deferred tax liability as at 1st October 2018 of shillings 400 million. For the purpose of preparing financial statement for the year ended 30th September 2019, the following information is available. Number one, the company has available for sale financial asset with a carrying amount of 80 million and financial asset at fair value through profit and loss of shillings 40 million. Both financial asset had reported losses in a fair value of shillings 8 million each as at 30th September 2019. 2. Inventory is shown at the level of cost and net realizable value. The cost is 3,200 million, while the net realizable value is 3,120 million. 3. Receivables had a carrying amount of 2,000 million after making allowance for doubtful debt of shillings 80 million and exchange gain of 160 million, which is unrealized. Both allowance and exchange gain are not allowable for tax purpose. Number 4, trade and other payables are stated at shillings 3,600 million after making provision for a discount of 40 million. 5. Property, plant and equipment had a carrying amount of 4,800 million and a tax base of shillings 4,000 million. Some landed buildings were revalued upward by 200 million during the year which ended 30th September 2019. Number 6, intangible asset consisting of trade licenses being amortized over 5 years had a carrying amount of shillings 240 million. This was allowed for tax purpose in full 2 years ago. Number 7, you're told to assume a tax rate of 30%. So what are we required to do? Roman 1, we are required to compute the relevant temporary differences. And Roman 2, we are required to make the journal entries to record the changes in the deferred tax liability. So we start with Roman 1, whereby the examiner was requiring the candidates to compute the relevant temporary differences, which are abbreviated as TD. And basically to compute these relevant temporary differences for the various items of asset and liabilities given from note 1 up to note number 6, we automatically have to prepare what is known as the schedule of temporary difference. The schedule of temporary difference. So in this schedule, we need to have a number of columns. The first column here will be for the items of assets, or basically will be for assets and liabilities. The other column here will be for carrying amount, and our figures there are given in million of shillings. The other column here will be for tax base, TB. Equally, we indicate that the figures are in million of shillings, and the last column here would be for the difference between the two, carrying amount and tax base, which is temporary difference, and also this will be in million of shillings. This one will be in million of shillings. So let's go through the information which you are given, starting with note 1. In note 1, we are told this company has available for sale financial assets, and also the company has another financial asset known as financial asset at fair value through profit and loss. So we're given information about two types of financial asset. We have available for sale financial asset, and currently, in accordance with International Financial Reporting Standard number 9, these financial assets are known as financial assets at fair value through other comprehensive income. But under the repealed standard IS 39, they were known as available for sale. Also, we are given information about financial asset at fair value through profit and loss, abbreviated as FVTPL. So we are given their carrying amount, like the carrying amount for available for sale financial asset, that is 80 million. So this is not a charge. Carrying amount is already provided. And for the other financial asset is what? Is 40. So there is something you need to note, that the carrying amount of this particular financial asset is always equal to their fair value. Always equal to their fair value, but the tax base is always equal to the cost. So because if the company decides to sell this particular financial asset, of which financial asset is investment in shares or investment in debt securities, when the company sells this financial asset and the company wants to determine the amount which is to be taxed, the company takes the sales proceeds. Sales proceeds is the amount the company receives from selling those financial assets minus their cost. So therefore, the amount which is taken into account in determining the profit which is to be taxed is the cost. So therefore, the cost here is the tax base. So that's why I'm saying the tax base is always equal to the cost. And how do we arrive at this cost? To arrive at the cost, we always take the fair value which you're given here, and then you less any accumulated revaluation what gain. That will give you the cost. Yes, so what you're told is that both financial asset reported losses in fair value of 8 million. So in our case here, we're not given a gain, but rather we are given what? A loss. So meaning that if you have a loss now, for the loss you don't less it from this, but for the loss you do what? You add. Because if this particular financial loss asset have reported losses, then it means that if the company had incurred them, for example, at a cost of 100 million, then that cost has done what? Reduced. So that now we arrive at the fair what? Value. So therefore, the tax base here will be equal to this plus the revaluation loss. The revaluation loss, we are told, is 8 million for each. So we add 8 million, we get 88. And here we add 8 million, we get what? 48. So and then we take this minus that, which will give us a negative 8 million. Negative 8 million. And because this is a negative, we say that this is the deductible temporary difference. The same case here. Negative 8 million, which is negative deductible temporary difference. So we are done with that, point number 1. So let's move to point number 2, where we are given information about inventory. This one is quite simple for inventory. So what are we told there? We are told the inventory are shown at the level of the cost and net traceable value. Basically, that's what we know. According to International Accounting Standard number 2, which governs or deals with the inventory, the valuation of the inventory, the inventory, the closing inventory should be valued at the level of two values: the level of the cost, or number 2, the net realizable value. So the level of these two is the carrying amount, but the tax base of inventory, when the company is computing the taxable profit, the value which is taken into account as far as the inventory is concerned is always equal to the cost. So therefore, the cost is the tax base, but the carrying amount is the lower of the two. So we are given the two values there, where we are told the cost is the 3,200, and automatically, because this is the cost, that will be the tax base. So in fact, we can just record that here. Tax base is 3,200, and then the net traceable value is 3,120. So we are saying the carrying amount will be the lower of the two. The lower of the two is that, which is 3,120. So we get the difference here, which will be 80, still negative, and that is deductible temporary difference. So let's move to the other point, number 3. We're given information about receivables, and we are told the carrying amount of receivables is 2,000 after making allowance for doubtful debt and including an unrealized forex gain of 160. So what you're given there is information about the receivables. So for the receivables, we have the carrying amount, which is 2,000 million. So we need to determine the tax base. The tax base for receivables, this one is always equal to the gross amount, because what you're given here, this is the net amount. So this net amount of 2,000 was arrived at by the company after deducting a figure of 80 million, which is allowance for doubtful debts. So this figure has already been deducted in arriving at this, and the company had included a forex, or basically an unrealized forex gain of 160 million. So this 160 has been added there. So and as a result of doing that, the company got the net amount. So, but how do we get the original amount of the receivables? To get the original amount of receivables, we take 2,000, we add the 80 million, which has already been deducted in arriving at this, and then we less 160, which has been added in arriving at that figure. That will give us now the gross, the original amount of what? Receivables, which is now the tax base. So let's do that. So we have 2,000 plus 80 minus 160. 160, and that will give us 1920. Yes, so we get the difference 2000 minus 1920, which will give us positive 80, which is a taxable temporary difference. Taxable temporary difference. So that's how we determine the tax base. So let's move to the other item, which is number 4. We are given the information about the trade and other payables. Trade and other payables. And we are told trade and other payables was stated at 3,600 million. So this 3,600 million is automatically the carrying amount. They were stated in the statement of financial position at that word amount, but we are told this is after making a provision for discount of 40 million. Equally, just like what you have said regarding the receivables, the tax base of trade receivables, and also that is the tax base of trade receivables and also payables, this is equal to gross amount, because whatever you have here is a net. And you're told this particular net amount of 36 is arrived at after deducting or after making a provision of 40. How do we get the original value? To get the original value, we take this plus 40. We take what? 40. But this take into account is an item of liability. Is an item of liability because all what we have here, all these are items of assets. This is an asset, this is an asset, this is an asset. But what we have here, this is a liability. This is a liability. So when recording an item of liability here, we record both figures as negatives. Both figures as what? As negatives, like that. Because this is a liability. So how do we therefore arrive at the temporary difference? To get the temporary difference here, we take the figure here, which is negative 36, negative 36, and then to this we deduct negative 3640. So we have negative 36, a negative and a negative becomes a positive. So that is negative 36 plus 3640. So let's compute that figure, negative 3600 plus 1640, which will give us a figure of 40. A figure of 40, so this is a positive 40, and that is taxable temporary difference. Taxable temporary difference. So I think we are done with that particular point there. Let's move to point 5, whereby we are given information about the PPE, property, plant, and equipment. And you're told property, plant, and equipment have a carrying amount of 48. No problem with that. And a tax base of 4,000. Tax base of what? Of 4,000, like that. The two figures are given. So meaning that we need to get the difference, which will be 800, a positive, which is a taxable temporary difference. But in the same point, we are told that some landed buildings were revalued upward with 200 million during the year. So this revaluation gain now, we are going to use that, or we are going to compute something known as a deferred tax on revaluation gain, deferred tax expense on revaluation what? Gain. So that one we take it into account specifically when preparing the deferred tax account. We don't capture that here because that revaluation has already been captured in the figure given, therefore 4,800, because automatically that is the revalued amount. So and then finally we have intangible assets. Intangible assets. So for the intangible assets, we are told this consisted of trade licenses being amortized over a period of 5 years and had a carrying amount of 240. Carrying amount is already given, but you're told that this was allowed for tax purpose in full 2 years ago. So remember, we said in our previous session that anytime the company has incurred a cost, like the company has paid for a license, and that cost has been capitalized, or the company has undertaken some research, the company has incurred some development costs in terms of undertaking a certain project, and those particular costs have been capitalized in accordance with IS 38, then those costs which have been capitalized, they will be accounted for as an asset in the balance sheet. In the statement of financial position, they will be stated there at cost minus accumulated amortization. So that will be the carrying amount. But now the tax base is the amount to be allowed for tax purpose, or the amount to be treated as allowable expense in the future. So in this case, we are told that this cost which was incurred by the company was allowed for tax purpose 2 years ago. So if it has been allowed for tax purpose 2 years ago, this amount will not be treated as allowable expense again in the future. So therefore, its tax base is equal to 0. So get the difference here, which is 240, and that is a taxable temporary difference. So in our case, we are done. So what we need to do is now to get the net amount here. To get the net amount of temporary difference, so we need to add all what we have here. We have negative 8, negative 8, negative 80, plus 80, plus 40, plus 800, plus 240. So that will give us a final figure here of 1064, which is a positive, and that will be net taxable temporary difference. Net taxable temporary difference. Yes, so basically that is it. That what was required in Roman 1 of that particular question. You can see the marks which were located in that particular question there were 8. So the figures which are marked are these ones. So this. So we have how many items? 1, 2, 3, 4, 5, 6, 7, 8. So basically, any candidate was able to compute those temporary differences correctly was getting 8 marks. And then in Roman 2 of that particular question, what are we required to do? We are required to make the journal entries to record now the changes in the deferred tax liabilities. For us to be able to do that, it is first of all advisable you prepare a deferred tax account so that you can know which items which cost the deferred tax liability to change from the figure given at the start to the figure given at the end of of the year. So therefore, let's prepare the deferred tax account here, and then we make those journal entries as required in the question. So Roman 2 journal entries. Basically to record the changes in deferred tax liability. So I'm saying before we make those journal entries, let's first of all prepare the deferred tax account so that we can be able to know which items, which caused the deferred tax liability to change. So this is the deferred tax account. So in preparing this account, we start with what you're given in paragraph 1, the deferred tax balance at the start of the year. So the deferred tax liability at the start of the year was 400 million. So what we also need to do at the end of the year, because we have a net taxable temporary difference, we need to compute the deferred tax liability at the end of the year, which will be equal to net taxable temporary difference times the tax rate. So our net taxable temporary difference is 1064 times now the tax rate. The tax rate, we are given that in note number 7 is 30%. 30%. So let's compute that figure here. We get the amount of the amount of what? The amount of deferred tax liability at the end of the year, which will be 319.2. So that is the deferred tax liability at the end of the year, and that is recorded in this account on the debit side down here. So this is carried down. Carried down is at the end, which is 319.2 million. And then we also have to remember that in note number 5, we had a revaluation gain. On PP. So in such a case, I've said what you need to do is to compute something called the deferred tax expense on revaluation gain. Revaluation gain, of which we compute this by taking the revaluation gain times the tax rate times the tax rate. So the revaluation gain is 200 million times tax rate 30%, which will give us what? 60 million, which will give us 60 million. So how do we account for this? We account for this by debiting the revaluation reserve account, crediting deferred tax account. So this account will be credited. The other entry will be in the revaluation reserve account with the amount of 60 million. 60 million. Also, anytime the company revalue this particular financial asset here, available for sale financial asset, or financial asset at fair value through profit and loss, there is a revaluation gain or loss, you also need to compute a deferred tax on the same. So therefore, remember this the revaluation gain on PP, property, plant and equipment. You also have to do the same. You compute a deferred tax income or expense arising from a revaluation gain or loss on financial asset at fair value through profit and, through other comprehensive income. So therefore, what we need to do is to compute the deferred tax, and in this case we are computing a deferred tax income on revaluation loss arising from financial asset at fair value through other comprehensive incomes, So the revaluation loss in our case, we know it was 8 million times what? The tax rate. So this will give us a deferred tax income of what? 30% of 8 million, which is 2.4 million. So how do we account for this? We debit the deferred tax account, debit deferred tax account, credit the financial asset at fair value through other comprehensive income revaluation reserve account. So this amount of 2.4 will be debited in this account. So the other entry is in financial asset at fair value through other comprehensive income revaluation reserve account with a figure of 2.4. And then I think finally what we need to do is basically to balance our account so that we can get the balancing figure, which now will be taken to the income statement as a deferred tax income or deferred tax expense for the current year. So the total on the debit side automatically is more. We have 400. On the credit side is more. We have 400 plus 60, which will give us for 60, 460. So what we less what we have on the debit side, 2.4 minus 319.2. Yes, that will give us a figure of 138.4. So this is the amount to be taken to the income statement, and this is a deferred tax income. A deferred tax what? Income. So I think having that now, we can be able to answer our question, because what the examiner was requiring is that we make the journal entries which made the deferred what? Tax balance to change. So we need to make the journal entries for these three items, this one, and this one. So we make those journal entries here. Journal entries. So let's start by making a journal entry in relation to this what? Deferred tax expense on revaluation gain, this one. So this is a journal entry on deferred tax expense on PPE revaluation gain. And I think I've already indicated the journal entry for that here. So what we do is that we debit the PPE revaluation reserve account with an amount of 60 million, that amount there. And then in that case, we credit the deferred tax account with the same amount of 60 million. 2, we account for this deferred tax expense, deferred tax, not expense, but rather income on financial asset at fair value through other comprehensive income, revaluation loss. So we have said we debit deferred tax account with an amount of 2.4 million. We credit financial asset at fair value through other comprehensive income, a revaluation reserve account with 2.4, and finally, we account for this amount of deferred tax income. So deferred tax income for the year, we account for that by debiting deferred tax account with a figure of 38.4 million and then crediting statement of profit and loss with an amount of 38.4 million. So that basically what was required there. Any candidate was able to do that, then scored the marks which were allocated there, and the marks which were allocated there were 2. Were 2 marks. So basically that is it, the end of that particular question, or basically that is it, that what was required. So as we wind up, I want to give an assignment which you need to attempt. It is based on a past paper question. So this is the question which was tested in April of 2023. April 2023. The entire question number 3. The entire question number 3 came from this particular topic. So basically make sure you attempt that particular question, but equally I also encourage you that you can acquire this particular division partner, which is actually updated to the most recent sitting. So, and if you have any challenge in terms of attempting this particular assignment here, you'll be in a position to get all the solutions for those particular assignments I'm giving at the back of this particular revision partner. So therefore, if you don't have this, make an effort of acquiring one. So therefore, we stop at that particular point, and basically that brings us now to the end of that particular topic of deferred tax. So for now is a bye. See you in the next session.